Thanks so much for tuning into yet another episode of Navigating Through Uncertainty. Our guest today, Mark Matthews, Head of Research Asia at Bank Julius Baer, joins in right now. Mark, great having you. Hope all is well.
All is very well, Niraj, and I'm very honored to be back. Thank you.
Let's try and get some of your thoughts into how are you seeing the current landscape. At the margin, Mark, there is a bit of a pullback, or quite a bit of a pullback in certain commodities. Maybe that leads to some bit of a relief in inflationary pressures as well. What's your sense of this pullback in commodities, the bit of a risk on that is coming to risk assets like equities as well? Is this short-lived? Is it possible to predict that? Or do you believe that this will get sold into, so to say?
So I would group them broadly into soft and hard commodities. And with the hard, I think the big one is oil. And I was actually just in the Middle East last week, and I met a senior government minister of one of the Gulf countries. And his thoughts that he conveyed to me were simply that it's highly unlikely Joe Biden would go to Saudi and come back with nothing on oil. Even though the Biden administration are saying the trip has nothing to do with oil, I think everybody knows it has everything to do with oil. And so to come back with nothing, I think, would be embarrassing. And I suspect that with a high-profile visit like that, they would have agreed to things in advance. And so the actual meeting itself would be more for show. So with that in mind, the person I met felt that there would be enough that Saudi and its neighbors could pump to bring the price down. At the time, oil was 120, and he told me $20, so that would take it to 100. And I've also heard from other sources that Saudi would be reluctant to see it go below 100 because you need to make hay while the sun shines, and we are transitioning into electric vehicles. Exxon's CEO said over the weekend, he said by the year 2040, all new passenger cars sold will be electric. Anyway, so I think that that supply response, plus at oil at over 100, you get more shale drilling in the United States. You get places like Canada that make money. Venezuela is being allowed to export to Europe, and I would just say, you know, that Russian oil and gas, it hasn't just disappeared. It is going somewhere, and satellites that track vessels strongly suggest it's coming here to Asia. So anyway, I think that oil is balancing now. The other thing is that we're in a time where a lot of people haven't been traveling for 2.5 years. They want to move around. They can again. If you look at the airline websites, the traffic is about 30 to 70% higher than even before COVID, the traffic on their websites. So I do think that we have this big blip of demand in the summer as people want to come out of hibernation, but that should settle back down. The demand should kind of cool off again. All told, I suspect that the oil price will moderate, you know, between 100 to 110 kind of thing. Then on the soft side, I'd simply say that my contacts in the food industry tell me that we have to wait for the summer to get a feeling for what the harvest is going to look like in the Northern Hemisphere and in China. But I must say that China has had a lot of wet weather, a lot of flooding, and it's not looking like a good harvest there. So on the soft side, the jury's still out, but my bias would be that prices should remain high.
In which case, Mark, while people cite the impact of the base effect, as well as people cite that a very high price for commodities leads to demand destruction and therefore a correction in prices, you still believe that even if inflation pressures were to come off, the new normal would be higher than what we've been used to. Would that be a fair assessment?
Very much so. I think when we look back at the last 10 years, actually it was abnormal. We thought it was normal, but inflation of 1 to 2%, which was the case in the United States from the end of the global financial crisis to COVID, was highly unusual and a function of, I think, mostly technological advancement driving down prices of durable goods and services, combined with, up until the trade war started around 2018, still a very, very vigorous sort of free trade environment. So the combination of the heightened geopolitical uncertainties. We see it in the war in Ukraine, but that's not the only place where I think we have geopolitical trouble. It's just the only place we have a hot war right now. The how should I say, the way that the globalization, I wouldn't say it's over, but it's rebalancing. So supply chains are having to relocate, and that's quite disruptive. I think that means, to your point, that we won't go back to 1 to 2%, but we will probably settle, I would guess, next summer for US CPI inflation and around the 3 to 5% range. And that's higher than we're used to, for sure.
So Mark, the drop down in risk assets was built on maybe a premise of, two major reasons. One was, of course, higher inflation, which started well before maybe the Russia-Ukraine conflict, and two, withdrawal of liquidity in a meaningful way, starting maybe July. Now, my question to you is, to your mind, how do equities behave in a scenario wherein inflation may come off, but will be still higher than normal? And as things stand, QT is a reality and liquidity starts getting off from the markets. How do equities behave in a scenario like this?
I think it means that the very long duration equities, in other words, growth stocks, whose earnings are in the distant horizon, will not be the great outperformers that they were during COVID times. And even before COVID, of course, the leadership of technology really started way back around 2011, 2012. So I think tech will not be the leader in the coming 5 to 10 years for that reason. The high inflation will necessitate higher interest rates, and those basically decrease the discounted cash flow of those long duration assets. And so the other thing is technology has become so big. I can't remember what percent the top 6 technology stocks are of the S&P, but I think it's something like a third. They're absolutely enormous companies. So when you get to that, $1 trillion size, which several of them are, you just can't grow the way you did before. So I think what I'm trying to say is the leadership will change. Where we are now is in a transitionary period where we don't see the leaders yet, because we just came out of this big bull market of the last 10 years that was tech driven. It's too early really to know what the leaders are. We have a couple of sectors in mind that we think will benefit from high inflation and relatively low growth. But will they be outperformers in a 5-year view? Really, in my mind, too early to say. So I think we're in a kind of confusing no man's land right now.
Okay, I will probe you on those, even if you may not want to. But just before that, my question would be, Mark, so, but equities at large have seen a bit of a pullback and a vicious pullback in certain markets before this recent bounce from the lows. Can you or are you even attempting to think of whether this bounce could be short-lived, or could it actually extend itself, or will it get sold into? Is it even possible to predict that?
Yeah, I don't think it's possible to predict things on a 3-month view, but on a 6-month and beyond view, I actually do think that things will be higher than they are now. And I mentioned earlier that technology stocks can't outperform because they're too big. They are still very good companies, these gigantic technology companies like Apple and Facebook and Google, etc., Microsoft. So they can perform in line with the market. And in doing so, I think we can analyze their recent performance, and it could give us a hint of where the broader market is going, because I think they now represent the broader market. So I want to say something that's slightly technical, but I think it's quite important to know. The NASDAQ 100 index is the index that represents the big technology companies. Now, usually we like to look at 200-day moving averages as signs of strength. We like prices to be higher than the 200-day moving average because it infers strong momentum, strong upward momentum. Sometimes, however, you can also use the 200-day moving average as a contrarian indicator. And in this case, what I'm about to tell you, that's how I'm using it. So we can look at the percent of NASDAQ 100 companies that are trading above their 200-day moving average. It's typically over the last 25 years been about 60 to 70%. Now it's down to 10%. In fact, it's slightly lower. 2 weeks ago, it hit 10. I think now it's about only 9% of NASDAQ 100 companies trade above their 200-day moving average, which is to say that the breadth of this decline has been very, very big. Now, the thing I want to tell you is if you measure the performance going forward of the previous instances when that ratio hit 10%, there were 15 of them going back 25 years, 15 times that the NASDAQ 100, only 10% of the members got to, just trading at their 200-day moving average. I can tell you that 12 months later, in every single instance, the index was higher by an average of 52%. Now, in between the beginning, where you hit the 10% and 12 months later, actually in 12 out of the 15 instances, it kept going down first. And then it kind of bottomed somewhere over the next 3 to 6 months. But 6 months forward, only one of the instances was the index still down, actually. So even 6 months forward, the odds of being higher than where we are today is very high based on that. Now, you could say, yeah, but 25 years isn't a long enough period of time to study because we got this big inflation that we didn't have over that period of time. And I would simply say that, every time that you hit 10%, it looked like the end of the world, whether it was the Greeks leaving the Eurozone or September 11 or the global financial crisis, it always looked bad and like there was no light at the end of the tunnel. So 12 months from now, if the market is higher, which I strongly think it will be, there will be a reason. We just don't know what it is right now.
Yeah, no, very well put. The prices move first, the reasons always emerge later. Mark, in which case, Mark, if indeed, despite QT and possibly higher inflation, if the statistics turn out to prove yet again that the NASDAQ is higher and thereby the US markets are higher, I presume Asian markets could follow suit as well, despite all of these uncertainties around globalization, reversing, and so on and so forth. Would you say that despite the oil price scare and a lot of Asian economies, including India, are oil importers, you might still have the markets being higher than where they are right now because the world at large and the West at large could be higher?
Well, I think the oil price is the million-dollar question. It impacts inflation very broadly, not just through transportation, but it permeates through pretty much every aspect of inflation. Even, the shoes that you're wearing probably have a lot of oil derivatives in them. The food we eat, over half of it needs fertilizers to grow. You need to transport it, et cetera, et cetera. So oil is the big one. And if oil is going up to, let's say, its previous high of 130 or 140 or 150, then I do think all bets are off. I do think that we will have some kind of recession globally. And I don't think that the NASDAQ 100 will be higher 12 months from now. So what I told you really is, I think, predicated on the oil price not going higher. So that's a major thing. It's the thing in my mind. Now, if the oil price is sort of around here 12 months from now, perhaps a little lower, I hope a little lower, then I do think that the Asian markets can go higher with the S&P. There's no doubt about it. But I would say that Asia is a very big geography, and you've got everything from Japan to India. So just saying Asia, it's a very broad statement.
Yeah, okay, I understand that. Sorry, so before that, just quickly dropping in a question. Your recession, US recession is not your base case, I presume, or is it?
Is not, no. So we look at 4 different inputs, and our recession model implies only 20% chance 12 months forward. Federal Reserve uses quite an esoteric model, which is the difference between the 3-month Treasury bill yield today and what the futures market is pricing it to be a year and a half from now. For whatever reason, their analysts have found that's their favorite thing. And indeed, when it inverted in the past, you did have recessions. It's nowhere near inversion today. It is signaling a pullback. It is rolling over, but at quite a high level. So it's signaling a slowdown, not a recession.
Okay. So with some hypothesis, Asia too could do well if oil stays under check. Couple of questions on India before we wrap up this conversation, Mark. What's your sense? Because there are a bunch of positives that have happened in India, including the whole China Plus One conversation, the PLI schemes and the boost on manufacturing, and the FTAs that India has been able to sign. I don't know what kind of rewards will they reveal at some point of time, but with Europe, with Australia, with Middle East, there's a bunch of those conversations happening. How have you looked at India recently?
Everything you said you're absolutely right that the global context is favorable to India now because I think that a lot of people will come back to China, but a lot won't. It's not just the lockdowns, it's the bad political relations between China and I would say broadly the West, but you could probably throw in another few countries on top of that, like Japan. So I'd say probably, I'm just pulling a number out of a hat, but half of the money that used to allocate to China would be reluctant on the basis that the politics could continue to deteriorate. And China is over a $10 trillion market. So you can imagine, even if half of the money that used to allocate there doesn't, that's a major windfall for India. But to my mind, the most important thing for India is that it was held back economically in the previous 10 years by the NPAs, which were a legacy of bad lending in the 10 years prior to that, the big bull years of the 2000s. And all of the reforms from the Real Estate Act to the bankruptcy law and the GST, demonetization, list is very long, which really, I think, slowed down what small and medium-sized enterprises in particular, their level of activity, because they weren't used to that. But I do think that most of that stuff happened around 6, 7, 8 years ago. It has been absorbed. The economy has acclimatized to it. So I guess what I'm trying to say is that the last 10 years were subpar economic growth because of the NPAs and the reforms. But I think approximately a year ago, the Indian economy somehow transitioned out of that. The NPAs peaked and started coming down. Small and medium-sized enterprises grudgingly became accepting of these reforms. And so we've seen, not only an uptick in the market, the stock market, and a lot of domestic interest in it through the SIPs, but the property market's going up too, which is psychologically very important for people anywhere in the world. Property is their primary asset. So they feel good about life in general if property prices going up. Anyway, putting all those things together, I do think it is a good market, and that's why we're overweighted.
You're overweight India. Awesome. That's good to know. My final question, Mark. If growth assets across the world may not be as much in vogue as value, I presume that's how I surmise your opening answer. Do you reckon the same could be in India? Because in India, the ones which are valued very high are not necessarily as much growth stocks as they are the consumption stocks, which probably grow at a steady state, but because they've done that for so many years, they are very richly valued. So when you look at India, would you look at it slightly differently from how the world will look at the world value versus growth argument?
Actually, I think we could, although the sectors are different, you're right, but broadly, the concept of value and growth would be similar in India in the sense that higher interest rates or a rate hike cycle tends to favor value and tends to disfavor growth. So I don't see why that wouldn't apply to India as well. But I would say that we're not looking for this rate hike cycle to be as much as the market is pricing. We're looking for a terminal Fed funds rate at about 3.5% by next summer. Mm-hmm. And I don't remember what the futures market's pricing in, but it's quite a bit higher than that. So once we've got that out of the way, I don't think it's such a high rate that growth will perennially be in the doghouse. It will have, it can still, the good aspects of growth. I think what is important going forward is that you've got to show your growth. You can't just say, oh, it's going to happen 3 years from now. You've got to have the cash flows this year and next year.
Got it. Mark, it's refreshing talking to you. Thank you so much for being with us today, and have a great second half of 2022. I hope to meet you both in person and on air.
Thank you so much, Niraj. Once again, it was a pleasure and an honor to be with you.
Thank you so much, viewers. Thanks for tuning in.